Two investors buy the exact same bond, same issuer, same coupon, same maturity. One buys when central banks have just started raising rates. The other buys 2 years later, after the rates have peaked. The bond is identical, but the first investor sees the market value drop as rates climb. The second locks in a higher yield, earns better income, and holds a bond that's well positioned as rates come back down. Even though the bond itself didn't change, everything around it did. That's what this video is about. We're going to look at 3 things that sit outside the bond itself but still shape what you earn: the interest rate cycle, geopolitical events, and whether European investors should be looking at US bonds or stick closer to home. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. Let's look at the interest rate cycles. Central banks set interest rates. In the Eurozone, that's the European Central Bank. And their decisions hit the bond markets directly. The basic relationship is straightforward. Bond prices and interest rates move in opposite directions. When rates rise, existing bond prices typically fall because newer bonds are offering better deals. When rates fall, existing bond prices can rise because older bonds are suddenly paying above market coupons. So where are you in the rate cycle matters when choosing a bond. Not because you need to time the market precisely, but because it could shape one key decision: the duration. If rates are high and expected to fall, longer duration bonds may be worth exploring. You could lock in an above-market coupon for years, and if rates do fall, the bond's market value can rise on top of that. The risk? Rates stay high or climb further, and the bond loses market value, at least on paper. The other scenario, rates are low or still rising, shorter duration bonds may suit a more cautious approach. They tend to lose less value as rates increase, and they mature sooner, so reinvesting at better yields becomes possible once the cycle turns. The trade-off is earning less in the meantime, and if you're not sure where the rates are heading, which is the case most of the time, a laddered approach across different maturities might give you exposure to both scenarios without committing fully to either. We covered how bond laddering works in a previous video, which we will link in the description. One more thing worth noting here: the starting yield on your bond matters too. A higher starting yield can act as a buffer, potentially absorbing more of the price impact if rates keep rising. A lower starting yield leaves less room for error with conditions moving against you. The takeaway? You don't need to time the market, but understanding where the rates are and where they are likely heading, this can shape better duration decisions than just defaulting to whatever yield looks most attractive today. Let's talk about geopolitical effects on bond markets. Central banks are not the only force moving bond markets. Political events, conflicts, and policy shifts can move the market too. The most consistent pattern is flight to safety. When uncertainty spikes, investors move capital into assets that they consider safe. Government bonds from stable economies are the default destination. That increased demand pushes prices up and yields down, even though nothing fundamentally has changed about those governments. Corporate bonds tend to behave differently in the same conditions. When uncertainty rises, investors start worrying about whether companies can maintain earnings and service their debt. So corporate bond prices can fall and yields can rise, even if the company itself hasn't changed. For investors looking to buy, that can actually represent an opportunity to enter at better yields. So what does this mean practically? The instinct during a geopolitical shock is to react to the headline. But a more useful approach is to check whether your existing holdings still match your goals. If you're holding government bonds for stability, you have no need for a flight to safety. that asset class is doing exactly what it's supposed to do. If you're holding corporate bonds for income, a temporary price drop doesn't necessarily mean the issuer can't pay. The question worth asking is whether the event represents a structural shift in their business or sector, or rather it's just short-term noise. Lastly, let's discuss European versus US bonds. If you are an European investor, you've probably looked at US bond yields and thought, why wouldn't I just invest there? And the numbers do look tempting. As of early 2025, 10-year US Treasuries were yielding around 4.5%, while 10-year German bonds were sitting around 2.7%. That gap exists because the European Central Bank has lowered its interest rates more aggressively than the US Federal Reserve, and the European economy has been growing more slowly. So on the surface, US bonds look like the better deal, but the yield comparison only tells part of the story. The biggest factor that gets overlooked is currency risk. If you are a Eurozone investor buying US bonds, your returns are in US dollars. If the dollar weakens against the euro, those returns shrink in euro terms. In some cases, the currency move can wipe out the yield advantage entirely, even if the bond itself performed well. Regulations is another difference worth knowing about. European bond access through European platforms fall under MiFID II, which means standardized disclosures of risks, costs, and key features. That's a meaningful layer of protection for retail investors. US bonds don't automatically come with that. So if you're buying them directly, as opposed to a European platform, that standard may not apply. For most retail investors, staying within the Eurozone removes the currency risk and keeps everything within a familiar regulatory framework. Adding US exposure can make sense as a diversification move, but it's worth going into it with a clear view on what currency risk could cost you and where regulatory protections start and end. Let's recap timing and market context for bond investments. The current phase of the interest rate cycle can shape duration decisions. It doesn't mean timing the market precisely, but being aware of whether the rates are rising or falling can help inform you which bond to consider. Geopolitical events tend to follow recognizable patterns. Government bond prices may rise during uncertainty as investors seek safety. Corporate bond prices may fall temporarily. In either case, checking whether existing holdings still match your goal tends to be the more useful reaction than reacting to headlines. And if you're comparing European and US bonds, the yield gap is only one part of the larger picture. If you are ready to explore bonds yourself, Mintos offers high-yield bonds starting from €50. You can build a portfolio manually by selecting individual bonds or automate with high-yield bonds portfolio. And if your plans change, the secondary market provides an option to sell before maturity. What aspect of market context do you find hardest to navigate? Rate cycles, geopolitics, or the Europe-US comparison? Drop a comment below. If this video helped, give it a like. Thanks for watching.